Hello, so we are at the last juncture of economics, and now we'll be doing with the last couple of readings of international trade and capital flows and currency exchange. These are slightly easy readings, but they do have calculations, so please pay attention and join the session. Thank you. Joined? Hello. Hi, hello. Good morning, everyone. Welcome to.
Good morning.
Now we are at the last section of economics, where these last two readings are something that you must be, seeing that on an everyday basis in the financial newspapers. That is balance of payment, trade deficit, export, import, trade surplus, quotas, tariffs, currency exchange, the movement in that currencies, GDP, and all those factors which you see very often in a research report or in a macroeconomic analysis or in any financial newspapers. That's what these last two topics are. They're very interesting, very practical, and you have too many questions, numerical questions. Whatever numerical questions you have in economics are in this particular sections. So let's start with that. The first of the last two topics that I'm going to do is international trade and capital flows, and then we'll do currency exchange. So before we move on, understanding what international capital flow or what trade deficit or surplus and everything is, let's understand some important terminologies which will help us a lot. Few of these we are very much used to, but let's understand and go in more detail about it. So imports, what does import mean? Basically, goods and services that everyone, including individuals, corporates, or governments, purchase from producers of other countries. Am I clear? So these are goods and services that we buy from foreign countries, correct?
Yes.
On the other hand, exports are those goods and services which individuals, corporates, or governments from other countries purchase from our domestic producers. So when other countries buy from us, from our domestic producers, it's called exports. Now, there are most of the economies in the world, and in fact, all the economies in the world do have export and import, right? In today's era, it's very hard to conclude that a country can survive without international trade. Am I correct? But at times in the past or right now also, there are some countries which do not trade with other countries. Not completely, but to a larger section, they don't trade with other countries. What do I mean by that? They don't freely trade with other countries. And not only freely, there are some extreme countries which have no trade with any other country. For example, North Korea. North Korea, except I think China or Russia, I don't think so. It trades with any other country. It has all its, requirements fulfilled by China. Clear? So there is some very few economies. Iran, on the other hand, is an economy which is not allowed to trade with many foreign nations because of the sanction that it has. In the past, Russia also had sanctions and all, and many small nations which are battling through economic, financial, or political crisis fall under this particular category. Okay, that is called autarky or closed economy. Am I clear? Yes.
Yes.
On the other hand, we have extreme version, that is free trade, where government has no restrictions or charges or imports or duties on any activity. Whereas trade protection is where there are too many restrictions or charges from governments in order for import and exports, right? Where do we fall India as? Do we fall under free trade or trade protection? India as a country falls under a lot of trade restrictions.
Yes.
We are still in the colonial trauma, so we have less free trade and more trade protection. Okay. World price of a commodity or a good is basically the price for those who want to trade where there is no restrictions. So basically, let's say a price of good in our country, assuming that there is no restriction, that's called the world price or the global price. So the price of goods or services in world market for those to whom there is no restrictions. Okay, so there is if government allows to freely let the market participants determine the price, then that's called the world price. However, domestic price of a good is the price of particular good or service in our local country, in our domestic country, which may be equal to the world price if free trade is permitted or different in case of restriction. What does it mean? For example, when Apple launches a phone, it launches with a global price tag of, let's say, $1,000. Okay. Now that's the world price of Apple iPhone. Clear? Just an example. But is that the same price of Apple iPhone when it comes to India after the conversion?
No.
No. Is that the same price in Europe after conversion? Exactly no. Well, why? Because every country has some form of restrictions in terms of import duties or some charges. All those ensure that the prices in the local market are not exact same. So how much is the value or how much is the price of Apple iPhone in my local country or my local currency? That's called domestic price, which can be same to the world price if there is no restriction, or it can be different. Clear? Right?
Yes.
Now you have exports and imports. The difference between exports and imports is called net exports. Now this net exports, if exports are more than imports, we say it's a trade surplus, or else we say it's a trade deficit. Trade deficit is a situation where exports are less than imports. Clear? Now there's one more ratio to understand the export import of a country, that's called terms of trade. It is a ratio of an index of what? Index of two things. The prices of countries' exports to the index of the prices of imports expressed in a relative base of 100. What does it mean? Let's say today export and import value is $100. Okay, so the ratio will be 1. After a year, the value of the exported good has become 110, but the value of imported good has become 108. So is the ratio going to be more than 1 or less than 1? 110 divided by 108. The ratio is going to be more than 1. So this increase in the ratio means that the price of goods exports have relatively risen more than the value of imported goods. Clear, everyone? So if this ratio is increasing, it means the export value of your goods is relatively higher than your
Imports.
Clear? That shows a very, very positive sign. For example, China, and I'm going to use a lot of Chinese example here. China exports high value goods and imports raw materials. So, its dollar value of export is generally higher than its dollar value of imports. So China's terms of trade or the index of trade basically is always positive. Clear? Everyone? Any
Yes.
questions till this point? Okay.
No.
Now, let's say there is a company called Johnson and Johnson, which sells various cosmetic products. Now, or Unilever, which sells various, FMCG products, fast-moving consumer goods. When they come up in India, set up their subsidiary, and then they sell goods in the local market here, that's called a foreign direct investment. A foreign direct investment is when there is an ownership of some resources which are productive, ownership of productive resources in a foreign country. So when these companies like Johnson and Johnson or Unilever, when they come in India, they have their own factories or they buy some land and then they do the production here. That's called foreign direct investment. Similarly, let's say a company from UAE invests in India by buying some, warehouses, which they often do. So that's buying of a physical structure, or they start up a retail operation in India. So that's called a foreign direct investments. On the other hand, if India goes there and buys some crude oil fields, or so That's ONGC does that. Well, ONGC goes abroad and takes auctions, take participants in auctions and takes control of the natural resources for, let's say, 5, 10, or 20 years. That's called FDI, foreign direct investment. It's just not only monetary investment, it's also physical presence. Clear? Everyone?
Yes.
Now, multinational corporation in economics, a firm that has made FDI in one or more foreign countries, that is called a multinational. So let's say we have Aditya Birla Group, which has operations all across the world. You have Etisalat from UAE, which has operations all around the globe, right? They do businesses across the planet. Walmart has operations now globally. No, in fact, it had globally also. Amazon. These are companies, Zomato. These are companies which have operations globally. Therefore, they are called multinational firms. Now, we already know what is GDP. GDP is market value of all final goods and services produced by the factors of production in the boundary of your country, within a country, during a period like 1 year. Okay. So now in your country, when I say all the goods produced in a particular country, right, or within the borders of a country, will the goods be only produced by local residents, or even foreign nationals, or even multinationals will produce? What do you think? GDP, does it include only the goods produced by locals or produced by everyone in your country, including foreigners? Tell me. Any idea? Yes.
It's not included.
It is included. So the biggest difference in GDP, and later on I'll come to GNP, GDP focuses on the country's boundaries. Anyone who produces in your country, whether it's your local company or your foreign company having a manufacturing plant in your country, that is a part of GDP. Okay. So let's say if a US company like Apple has its operations in China, so it's producing iPhones in China, those iPhones are a part of whose GDP? Chinese.
China.
Are you getting me?
Yes.
So produced within the country's boundaries. That's GDP. Now, what if, let's say I am an Indian citizen and I give my services not in India, but I give my services in UAE, Dubai or Abu Dhabi, and I earn my income from there, and I give my services or I do my businesses there. Will that be a part of GDP? Will that be a part of GDP?
No.
No, because GDP means whatever is being produced in the country.
Within the boundary. Yes.
So now this part, what a citizen is producing, whether in India or abroad, that is a part of GNP. Gross national product is the market value of all finished final goods and services produced by the factors supplied by residents of a country, regardless whether it takes within the country or outside the country. So if I'm a resident, but I'm giving my services and I'm making, or let's say I have a manufacturing plant of pencils, but I have that plant not in India, abroad, then it's going to be part of the GNP, but not GDP of India. However, let me tell you, that will be the part of GDP of foreign nation. Is that clear?
Yes.
So the biggest difference between GDP and GNP, biggest difference, yes, the income to capital owned by foreigners invested within a country is included in the domestic country's GDP, but not GNP. So basically, foreigners, whatever the money that they generate in your country is a part of GDP. And GNP. On the other end, about your own citizens, what your own country's citizens produce abroad, that is a part of GNP and not GDP. So the income of a country's citizens working abroad is included in GNP, but not GDP. Is that clear? That's the biggest difference between GDP and GNP, correct? Any questions?
No.
So our discussion of the topic is international trade. So tell me, should there be international trade? What are its benefits? Should we trade with foreign countries, irrespective whether we like it or not? Should we trade with them? Yes or no?
Yes.
Of course, we should trade with them, right? Why? Because you get lower cost goods, you get better quality, you get a lot of other advantages. Like what are other advantages you can think? Basically, I can get an advantage that if I'm exporting, my country's companies or corporations profitability, efficiency, wage level, employment, so many things will be the advantage of international trade. However, there are some arguments against it because of some costs due to international trade. Well, international trade is a product of the globalization or the globalized world that we are into. So let's first understand what is the benefit and cost of international trade, and definitely what is going to be more, the benefit or the cost? Well, the benefit is going to be more than the cost,
More
and
than
that's why
cost.
we do international trade. So what are the economic theories supporting it? Even that we'll see, right? So what are the benefits? As we discussed, lower cost of goods for imports. Due to exports, there is large employment, wages, profitability for your companies, better allocation or efficiency of resources, right? And then you have consumption of large bundle of goods, and very important is specialization. A country which produces or exports some goods on a large scale, over the period it gets the technological edge that it becomes master in. For example, Germany specialized in engineering products, right? uh, China has now been specialized in almost all the products, but US in technological products, right? Japan in technological products. So over the period, countries have got specialized into some products which no other country come close to it. For example, Korea is known for, South Korea is known for, come on, what is South Korea known for? Tell me.
Technology, like electronics or something.
All
Not sure.
your cars, Hyundai, all these cars, most of the cars are from South Korea. You have
Yes.
the computer chips which comes from South Korea. Okay, South Korea was known to be the world of semiconductors. Samsung comes from Korea. Okay, so phones, semiconductors, basically the chips, and cars, they have a dominating part. The major part comes from South Korea. Phones, to be precisely, semiconductors or cars. Of course, now you have a competition coming from China for all the sections. Japan is known for its cars, for its various technological products. Germany is known for cars,
Cars.
known for all the engineering products, for machines. German machines are very well known. All the capital intensive or all the heavy machineries comes from Germany. Uh, do you use elevator? Have you seen that? What is the name of the companies which have elevators in any area that you would see around you? What most of the elevators come from which company? Have you observed that while you travel or while you go through an elevator? Have you observed which are those companies? Mostly they come from two countries, Schindler and Otis. Have you heard about that? Have you observed
Otis. Yes.
Otis and Schindler, right? Correct.
Yes.
So Schindler is basically a Swiss company. Okay. So I'm trying to say that, Switzerland, which is generally known as the world's tourist destination, not many people know that it is also one of the world's largest producer of elevators, engineering products. ABB is a very famous company from Switzerland in engineering. Switzerland is also known for pharmaceutical products. Apart from what we've read in books as dairy products, Switzerland is also very well known for pharmaceutical products, right? And Switzerland, very well, we all know for luxury products like watches. So gold jewelry is very important trade product of Switzerland. So small countries have over the period become specialized. Now everyone who wants to buy a watch, they refer Swiss watch. Swiss watch is something that we refer, correct? We say German engineered car or Japanese made machine. That's how over the period every country has got some specialization tag which we refer to them. Got it? Now, in that way, can you tell me something that people associated with Canada, that this is the best about Canada, that okay, this is made from Canada? Any product that you feel is globally very famous of Canada? Any product? Yes.
It's
Tell me.
mostly it is like you can say maple, like
Okay.
it's
When do
very
you,
unique, like
okay.
maple, it's maple syrup.
Okay. One product of Canada which I would like to highlight is most of the train locomotive engines of the train in the world are made by a Canadian company called Bombardier. So that is what Canada is very famous for. Second, Canada is very famous for exporting gold. You won't believe this, but yes, there's a bank which is very famous for that. Most of the banks in the Southeast Asia or various other countries as well, they buy their gold from a Canadian bank called Nova Scotia. I'm sure Nova Scotia, you must
Yes.
have heard. So Canada is also famous for a lot of engineering products, defense equipments also. So that's what Canada is known for. Okay. So that's what the benefit of international trade, however, is. There are some costs related to international trade, but most of these costs are borne by those unskilled laborers in your country. So borne those in the domestic industries that compete with the imported goods. For example, US has suffered a lot of job losses in the section of IT. Of course, many Indians are to be blamed for it because they have taken over a lot of jobs in US in the IT sector, correct? So there's loss of job majorly in the unskilled sector, and to a larger extent even skilled sector. So many of the unskilled sectors where the jobs are easily replaced by better quality or cheaper products. So due to the steel industry's phenomenal rise in China, the steel cost became so low that people started shutting their steel plants in their local country and started importing from China. Got it? So that's the cost of globalization, and due to which politicians many times go back on globalization, right? And this creates a lot of income inequality as visible in US and many other countries. Clear? So overall, there are some benefits and there are costs, but what is more? Definitely the benefits outweigh the cost, and that's why we do international trade. Now, there are two economic theories supporting that: theory of absolute advantage and theory of comparative advantage. What is absolute advantage? Very interesting theory. It is when you can produce a good at a lower cost or lower resources when compared to another country. When compared to another country. For example, electronic goods, China can produce much at much cheaper rate than India. So China has an absolute advantage over electronic goods over India. Correct?
Yes.
Now within India, okay, let's consider two goods. Let's say wheat and rice. Now, of course, they are not exactly comparable, but economically, if let's say I employ one labor to produce wheat and the same labor to produce rice, if I'm able to produce more rice, then I can say I have a comparative advantage in production of rice than wheat. So when a country has advantage with a lower opportunity cost in the production of one good compared to another, that's called a comparative advantage. So absolute advantage is same good different country. Correct? Comparative advantage is same country, different goods. Are you getting my point?
Yes.
Absolute advantage is same goods, different country. Comparative advantage is same country, within the same country, two different goods. Okay? Now, based on this, I'm going to do a case study and we'll solve an example which will tell us that why international trade does make sense, whether you have a comparative advantage or an absolute advantage. Now, this was highlighted by a very well-known economist in the 19th century, David Ricardo. And that's why we call it as a Ricardian theory. David Ricardo presented the advantage of trade in 1817, where he analyzed that regardless of which country has an absolute advantage. Absolute advantage means which country does better. Okay. So let's say two countries, India and China. I'm sure there are various goods in which India is better than China and many goods where China is better than India, right? So if whichever countries have absolute advantage, or they are saying regardless of which country has an absolute advantage, there are gains from trade as long as countries' opportunity cost of one good in terms of another good are different. So if the opportunity cost of producing wheat is different in India than in China, then definitely it makes sense to have international trade. Clear? Right? That's if you have an absolute advantage. Clear? However, he went on to further say something very important. What is that? He concluded that even if a country does not have an absolute advantage, still it should go for international trade. Why? It can export the goods in which it has comparative advantage. So the conclusion is that if you can produce more rice than wheat, and still there are many other countries where rice is, relatively cheaper than your country, still you can sell this excess goods to various other countries. You can export them. So how is that going to be possible? We'll see that. But the conclusion is that what Ricardo is saying, that whether you have a comparative advantage or an absolute advantage, if there is any advantage visible, you should go for international trade. Is that clear? Everyone? Any questions? Okay. Now let me show and prove that with an example. So I've taken up a case study of import and export, basically trade between India and Germany. Germany is the fourth largest economy, and now India very close to that. So India imports from Germany various products like chemicals and auto components and various engineering or various capital intensive products, mostly related to technology. On the other end, India also exports to Germany some items like food and beverages and various pharmaceutical items. As you know, we had discussed in the past that India is the world center of exporting medicines. Okay. So we have Serum Institute, which is the largest manufacturer of pharmaceutical products in the world. So we do export leather, textiles, medicines, and in return we get auto components, most of the German cars that we have in India, plastics, pharmaceutical, and various other products. Okay. So I've taken up an example of some car parts, that is auto components, and some grains like kgs of wheat. These are the two examples. What do you notice in this example? When I say absolute advantage, it means I'm comparing two countries for same good. So let's say car parts and wheat. Okay. When I say comparative advantage means I will be focused on a particular country's two different products, right?
Yes.
So on the basis of comparative advantage, what do you think? Which country, Germany has comparative advantage in the production of? This is output per unit of labor. Okay. All this is output per unit of labor. Let's say output per unit of labor. So one labor can produce what exactly? That's what this is. So tell me, what is the comparative advantage that Germany has? What is Germany able to do
Car.
better? Number of car parts, right?
Yes.
Correct. And what is India better at doing? Producing
Wheat.
wheat. So can I say comparative advantage of Germany is in the production of car parts, and for India it's in the production of wheat. Now, how do I know that? Well, we can calculate the opportunity cost. For example, for Germany, the opportunity cost for car parts, whenever I say opportunity cost, you have to compare what is the best other alternative. So what is that Germany can do instead of car parts? It can produce what?
Wheat.
90 kgs of wheat, correct? Against 100 car parts. So the opportunity cost of Germany is 0.9 kg of wheat against car parts. Clear? So for every single car, what is Germany losing? 0.9 kg of wheat. Clear? Clear? Now I can say it in the other way also. For example, the opportunity cost for wheat for Germany. Instead of wheat, what can Germany produce? 100 cars. So divided by the quantity of wheat. So I can say 1.11 units of car parts. You can just say car parts is what Germany can produce instead of wheat. So tell me, where is the opportunity cost more, in the production of wheat or in the production of car? What is basically more, what is that Germany can do better? Germany can do better is with production of car. So basically, if I were to look here, the opportunity cost for producing wheat is more than the opportunity cost for producing car parts. So therefore, Germany is better off by producing car parts instead of wheat. So can I say here Germany has a comparative advantage in production of car unit? Clear? Now, if you notice, the Germany's opportunity cost for car is less, right? But for wheat is more. So I should not produce wheat. Clear?
Yes.
Can you now say the same in terms of India? Yes. Opportunity cost for car parts for India, I will say 80 divided by 40. So it's 2 kg of wheat that India will lose for producing every car part. On the other end, if I were to take 40 divided by 80, that's what the opportunity cost for wheat. So I will just lose 0.5 units of car parts. So what am I going to lose more? I'm going to lose wheat more. So the comparative advantage that I have is in wheat production. Yeah. So the conclusion is that, what is the conclusion here? That comparative advantage for Germany is in the production of car parts, and for India it is in the production of wheat. But what is absolute advantage when I compare between Germany and India? So just check car parts, where it is better to produce car parts, in Germany or in India? Come on. Which country produces better, more car parts?
Germany.
Germany is better in terms of car parts. That's an absolute advantage that Germany has. In fact, in the terms of wheat production also, Germany is better. Are you getting it? So can I say Germany has an absolute advantage in the production of car parts and wheat both? Is that clear? Now, tell me one thing. Does Germany require India? With the same unit of labor, Germany can produce more cars and can produce more wheat. So why does Germany require India? Clear? But let me tell you, if let's say there is only one labor in Germany, what should that labor do? Either it can produce wheat or it can produce car, isn't it? What should that labor do? Come on.
Produce
Produce
car.
car parts. Then what about wheat? Well, then it has to import wheat. Why? Why? Because the cost of production of car parts, or the value at which car parts will be sold, isn't that going to be more profitable than producing wheat? So what is Germany thinking? That let me, even if I have an absolute advantage in production of car as well as wheat, let me focus my resources in producing more quality goods, more high value goods, correct? And the other goods which I can import, even if someone does not do better job than me. Is that clear? Right? Are you getting it? Yes or
Yes.
no? So I've put up some example here that how international trade works, how it is eventually benefit for both the countries. So let's say if I deploy 10 workers or 10 laborers, okay? Now, what is Germany to produce better? Car parts. So if I move those 10 workers from wheat production to car parts, those 10 laborers will produce how many car parts? 1,000, correct? And in case of wheat, how much will I lose? Minus 10 into how much? 90. Am I correct? So I'll lose 900. Clear? Overall, what will happen? Overall, if you notice here, if I move 10 workers from wheat to car parts, net, can I say I'm able to produce 100 units more of car?
Yes.
And if India focuses on wheat production instead of car, then let's say 10 people I'll move from the car section. And how much were they producing car parts? 40. So I'll lose 400. But what will I get? 10 into 80, correct? So I'll be able to produce 400 kgs of wheat more. Clear? So overall, what do you notice or what do you observe here? That the total production of the combined country has increased by how many units of car?
100.
And how many units of rice kg? 400.
400.
This is called the gains from trade. Now, which one will have more bargaining power? That depends on what is more necessary. Is car parts more valuable, or wheat production? What is more essential? What is more valuable? That depends on both countries' negotiation power. So the negotiated terms of trade will determine how the two countries share these gains, but definitely there are gains, right? The important result, what is the important result here? The important result is that the total output has increased through trade. There is a greater specialization by Germany in car production than that in the wheat production. Is that clear? Correct. Now, I'll also give you another example, a very practical example, right? Now, let's say Germany is myself and India is my staff. Let's replace that Germany and India with yourself and your staff. Okay. Now you can do better sales than your staff, isn't it? Because you are the owner of the company. Am I correct? Yes. You can do better sales than your staff if you speak to clients, right? And you can also assume, let's say I have a very good experience in typing, so I can also do better typing. So I'll tell you one thing. Let's say instead of Germany, I put myself here as Kunal, and here is my staff or my colleague. And the two things that we do as an activity is that we do sales or we do typing. This is what a practical example I'm giving you from my business. Okay. Well, if I work on the sales, I may be able to generate 100 clients. My staff will be able to generate 80 clients. Right. If we do typing, my staff is able to do 120 pages, I'm able to do 200 pages because of my typing experience. Now tell me one thing, your Kunal has an absolute advantage in the production, in sales, yes or no?
Yes.
Also in typing.
Yeah. Yes.
Does that mean I should do both? Well, I can do only one. You're getting it?
Yes.
Correct. So even if you can do everything, does not mean you should do everything. Why? Because my resources are better utilized at generating sales than typing. So I know that my staff does not do better typing as I want, but still I should let them do the typing because my opportunity cost is more in generating revenue or generating sales. Make sense?
Yes.
Correct. So remember one thing, this is based on the concept which is not written here. You can do everything does not mean you should do everything. Okay. Clear? So even if you can do everything, you should not do everything because you should give the more productive work you should do yourself, which generates more revenue. And even if the work has, even if you have better absolute advantage than others, the lower quality work you should always and always outsource. Is that clear? So when Germany or US outsources their services to countries like India and China, does not mean that they can't do the job better. It just means that they are focused in more qualitative aspect, more a more technological aspect, which generates them more revenue. Is that clear?
Yes.
This is why richer nations always focus on technology, and the other nations like the Indian subcontinent, all the nations, we focused on labor. Clear? Right? Any
Yes.
questions? Any questions on this very important?
No.
No problem, right? Okay. Now, to take this further, we also have an example called the production possibility frontier. Now, we just discussed that. What did we discuss? That by producing one good compared to another, what happens? Your opportunity cost is better, right? It's always better to focus on one good compared to another. Now, what I would like to show you here is that over the period, what happens? A country becomes specialized in a particular product, and then it will keep on increasing its production of that particular good, right? But tell me, if you constantly keep on producing a good, initially what happens? The cost of the production, because of the scale, comes down, correct? But later on, there will be increasing in costs, and hence increase in the opportunity cost of export goods. Why? Because of high wages and all. What will happen eventually? The cost will rise. So even for China, after a point of time when the Chinese economy has already uplifted a large amount of people from the low income group, now these Chinese people will demand higher and higher wages. Are you getting me? Yes or no? So due
Yes.
to this high wages, what will happen eventually? China will be having a slump in its production of that export goods. That was same way it happened in Japan or Germany in the after the World War II. When Japanese economy got uplifted and German economy got uplifted, they started the labor intensive work started becoming more costlier. So here is an important thing. What is that? We are going to focus on production possibility frontier. What does production possibility frontier tells me? It gives me the combination of goods that I can produce, the two best combination of goods. Here if you see, the two goods that are being given is food and machines. Clear? So what is the opportunity cost of food and machine? That is the production possibility frontier. The slope measures the opportunity cost of one good in terms of another good. Here they have given the slope of 3, -3. What does -3 means? When it becomes negative, first of all, negative slope means now producing, the opportunity cost has become negative, means now
Negative.
it is not feasible to produce. What does it mean? Let me tell you. The slope of the -3 states that opportunity cost of each million machine is 3 million tons of food. So to produce each machine, how much quantity of food am I losing? 3.
3.
So if the country were to increase the production of machinery, the amount of food production foregone would increase. This shows negative slope of the frontier. So here the slump that you see here, this slump tells you that now after a point of time, it becomes not feasible to produce machines, which means you can produce machines, you are better at that, does not mean that you always keep on producing machine. After a point of time, the opportunity cost will rise, so you are losing more food as compared to machine. Clear? Right? Many rich nations are facing this situation where they have become so technological intensive or capital intensive that they are now heavily dependent on food products from foreign nations. Clear? That's where the opportunity costs are increasing. Clear? Getting my point?
Yes.
This happened with a country called Qatar. Qatar was facing uh, sanctions from its other GCC partners like UAE, Saudi, Bahrain, and I think Egypt. So Qatar was facing a blockade. Now Qatar is a very rich country. In fact, I've shown you in the previous topic that it is the world's richest country in terms of GDP per capita. But because of the blockade, Qatar had all the monetary resources, right? But it lacked shortage in food because now the food supply could not come. So its milk supply was completely come to a halt. Are you getting my point? So what Qatar did, you want to know? Qatar sent its planes to Australia and New Zealand and got huge fleet of cows from there to Qatar. Okay. So it brought a permanent solution to its milk industry by not depending on its neighbors. It brought the entire breed of cattle from Australia and New Zealand, started breeding them in Qatar, and now Qatar is becoming self-sufficient in many such products. Clear? So they were facing a situation that they had everything, but the opportunity cost of food was very high. So now Qatar has realized that it has to become self-sufficient in food also, because its opportunity cost became very high. Clear? Yes.
Yes.
So now there are two models of trade. One which we just saw, which was based on Ricardian model, and the second is Hawkshire and Olin model. Now, just to highlight what these two models are based on. See, first, to do trade or produce goods, you require factor of production. Which are the factors of production? Land, labor, capital, technology, right? Now, am I correct? These are the capital factors of production, right?
Yes.
Ricardian model considers one factor of production as the most important, and its thesis is based on that, and that factor of production is labor. Okay. Now, what does Ricardo's theory states? Ricardo's theory states that the source of difference, absolute advantage is the difference, right? Who can produce more, right? That's what absolute difference was. If you notice, what was the difference between two countries here? The labor is able to produce more car parts than India or more wheat than India, right? Why is that so? Why is the labor able to produce more in Germany than in India? What do you think that German labor has more?
Skilled.
Sorry?
Skilled.
Skill. or basically it says that this skill is nothing but due to technology. So what Ricardian model tells that the one factor of production, which is the biggest difference between comparative trade, is labor, and that labor is due to the difference in technology. So let's say even if a country does not have an absolute advantage like India did not have absolute advantage, correct? Still it could gain from trade if it had a comparative advantage in the production of one good compared to another. Now, did you notice that or not?
Yes.
Even if India was not better at either of the products, it can focus on where its labor produces more, that is wheat, and trade with Germany. Clear?
Yes.
So a country with lower opportunity cost in the production of good has a comparative advantage in that good, and over the period will specialize. So India's wheat production or rice production is so well known in the world, especially basmati rice, that now India has become specialized into it, and therefore we are able to export that more. Clear? Now the focus here was, the focus in the Ricardian model was on labor,
Labor.
one factor of production. Whereas the Hawkshire and all-in model focuses not only on labor but on capital. Capital. The conclusion of this model is that the country that has more capital will specialize in the capital-intensive good. So, which country has more capital, Germany or India? Germany or India?
Germany.
Germany definitely we know has more capital than India. Therefore, Germany should focus more on
Capital intensive.
capital intensive good. Yani, I mean Germany should focus more on producing high quality or high value goods than India. Clear? So it's just not a concept of labor, but also the concept of capital. So they are saying the country that has more capital will specialize in capital intensive goods and trade for less capital intensive goods. Therefore, Germany should produce more capital intensive good, that is car, instead of food grains. The theory allows for the possibility of income redistribution through trade, especially with the international trade factor prices display a tendency to move closer together in the long run. What does it say basically? That over a longer period of time, what will happen? The international prices will come closer. So, so a particular country who is better at capital intensive should produce that only, and for the other product, it should outsource. So the Ricardian model only says that the difference between two countries, advantage is due to labor, which is due to technology. Whereas the Hawkshire and Auden model says it's not only due to labor, but also because of capital. So the more capital intensive product should be focused by the one who has more capital, right? So if I have more capital than your country, then I should produce those where the capital requirement is higher. Clear?
Yes.
So this is all about why international trade should be done and what are the bases behind that. Correct. But even after understanding all this thing, does all country freely allow international trade? Trade means movement of goods and services, or capital means movements of borrowing and lending. No. Many countries allow easily export and import of goods. Many countries restrict that. So there are two types of restrictions that we are going to talk about, which are a problem in the world. What are the restrictions? Restrictions in terms of trade and restrictions in terms of capital. So what is trade restrictions? First of all, what is international trade? Export and imports. Clear? What is a trade restriction? Trade restriction is when a country does not freely let you trade with another country. Am I clear?
Yes.
So there are various reasons that governments give for this. Some of the reasons, economic support, like infant industry or national security. Infant industry means the industry is at a very nascent stage. So government support makes sense to uplift that industry, right? For example, a lot of startups are being, or agricultural industry or startup industry, these are industries of importance. So government may want to give them enough subsidies or enough benefits compared to foreign partners or foreign players, correct? And especially if it is a matter of national security, like defense products, governments will always support domestic defense products company than foreign products company. Is that clear? So these two reasons have support from economists, clear? But then there are various other support, there are various other reasons that are not supported by economists. Are you with me on this? Which are the reasons that economists do not support but governments give? Protecting domestic jobs. US keeps on telling, right, that I want to protect jobs in US and therefore we should not trade with China. Have they reduced their trade with China? Absolutely
No.
correct. Protecting your domestic industries, UK tried doing that by telling that let's protect our steel industries by putting a lot of restriction on Chinese products. Eventually what happened, UK's biggest steel production plant by Chorus, the UK's biggest steel plant, had to shut down. Okay, so that was the situation. Retaliation for foreign trade restrictions. So if it's a revenge because you have put some restriction on my country, I will also put. Now that is not a valid reason for putting restrictions. Clear? Government wants to collect more money through tariffs. Tariffs are what? Tariffs are charges on import or export. Countering the effect of government subsidies paid to foreign producers. Yes. So if the government is giving some subsidy to exporters, why is the government giving subsidy? To help them in competing. Well, even that is not a valid reason as per economists. Economists believe that is not the reason that you have restrictions. Okay. Preventing foreign exports at less than their cost of production, or so-called as dumping. As I said, India and China both are known, not only China, okay? India and China both are known to dump their products in the foreign nation. So what do you mean by dumping? What do you mean by dumping? Yes. Anyone out there? What do you mean by dumping? No one? Is anyone in the class?
Like disposing.
What?
Disposing.
Disposing. Not exactly. See, I'll tell you one thing, everyone out here, that I have detailed out the notes in such a manner that you won't even require me. Trust me, I just give you these sheets. You can just do self-study and you can know everything. I've made the notes in that manner. But the reason I'm having a discussion is that you all can give me your inputs. Dumping is something where, let's say an example like China always, let's take the example of steel because we're discussing that. China overproduces steel. So much so that the cost of steel becomes very low because of scale. Now this cost has become so low that it is below the global price. Now what will China do of this excess steel that it doesn't require? It will start dumping at the cheapest price in the global markets. For example, let's say, what do you do with the extra food that you have made at your home? What do you normally do with that extra food that you have made at your home?
Reuse it.
You give it to someone for free, right?
Yes.
Because for you anyway it's extra, correct? Now just imagine that in terms of trade. China has anyways produced too much of extra steel. Now what will it do? Well, it can sell it at whatever price it gets. Clear? This is what India and China are accused in the international forum, that they dump their excess production in the global market and break the price and local markets in the foreign countries. Clear? So therefore, international communities put a lot of duties and tariffs on Indians and Chinese products. Clear? Now, all these arguments are not supported by economists. So what happens due to them? Does it benefit the international trade or not? We are going to discuss that. But what do you think? Having trade restriction, does it benefit the global trade overall?
No.
Well, in the short run, it does help survive some of those weaker sections of your industry. But in the long run, it's a loss. Getting it? So we are going to see that how. But before that, let's discuss some of the trade restrictions which we often see in the international market. Tariff. Tariff is taxes on imported goods. Who charges on that? Government. For example, what is the import duty on cars? Imported cars in India.
Almost 80%.
Yes. Any other guess? Do you know what is the import duty in India? Well, it is above 100%. So if I want to buy a Land Cruiser, and if it is of $100,000 globally, if I want to buy that in India, it is $200,000. If I want to buy a Ferrari, which is of $200,000 globally, in India, I have to pay more than that. I mean, I can buy two in that. Are you getting it? So in India, imported cars have a duty of 100% plus. That's so unfair, isn't it? What do you think? Is it unfair or fair? Tell me. Is it unfair or fair?
Unfair.
Absolutely unfair by India. Because then when we sell products abroad, and if they start charging for our bikes and cars, the import duties, or for some emergency medical equipments, if they start having duties on that, we'll be nowhere. Are you getting my point?
Yes.
So, our pharmaceutical industry, our IT industry, we always crib about it, right? That US is not giving free visas, not easy visas and all. Is India giving easy visas? Absolutely not. I have spoken to one of my friend from France, and he is in India, having its business in India, and he's a French citizen, by the way. So I was actually, talking to him that, when I worked in UAE, if you lose a job in UAE, you have to vacate the country in 30 days. 30 or 90 days, something like that. Assume, let's say 30 or 90 days, okay? So I was complaining him that, what, India is so good that, if you go in foreign country and if you lose a job, you have to leave the country within 30 days. So he told me, what, that India is much worse in that case, where if I lose a job, I have to vacate the country within 15 days. So India does not even allow them to stay more than 15 days. So I was completely shocked. I thought we have the tagline of that, what we call Atithi Devo Bhava. That means we welcome everyone, right? But we throw them much earlier than they do. India makes it very difficult. Check it online. India makes it very difficult for foreigners to travel to India. But Indians want very easy access when they want to travel abroad. I have never faced any issue while traveling any part of the world. But I've heard from my foreign friends that they find it very difficult to pass through Indian immigration. It's very difficult for them to get visa. India, I don't know, why does India not allow them? So India need to ease out its policies. We have a very good policy for sending away people from India forever, including those scamsters. But we don't allow foreigners to come to India. So that's very unfair. Okay, that is the situation. I'm sure many of you may not believe me unless you speak to your foreign friends that how difficult for them it is to apply for a visa to India. Okay. So taxes on imported goods, that is tariff. Quotas. Quotas means limitations on the amount of imports. So for example, we have a quota on some foreign products where they cannot sell more than that. So it's a limitation on the quantity. Tariff is all about price. Quotas is about quantity. Is that clear? Yes or no?
Yes.
Then you have export subsidies. Export subsidies is what governments do very often. They give a lot of subsidies in terms of lower interest rate, tax rebates or discounts, or easy access to credit. All these are export subsidies that government pays to exporters so that their exporters, our government exporters, our local exporters have more advantage than those foreign support, than those foreign exporters. Minimum domestic content requirement that some percentage of product content must be from the domestic country. This is again where India is very much accused by Apple, that we had put a condition on Apple that 30% of its product should be made from India. Now Apple says, I cannot make even 10% product from India. India needs to upskill itself for me to source 30% from India. So Apple said that I'm not McDonald's, that I can take potatoes and breads and cheese from local market. Mine are very highly skilled products. So if India is ready for that, then I can do it. So you know what? Apple is not having full-fledged excessive operation in India because of this condition of minimum domestic content. Still, we reduced it substantially, and India has given a lot of leeway to Apple in that sense. So Apple can sell products in India because the demand is very high and you cannot restrict companies like Apple. Clear? But many foreign players complain about this thing about India, that India forces them to buy goods from India, but India does not have that skill. Clear? Then there are voluntary export restraint. It's a self control basically. It's a country voluntarily restricts the amount of goods that can be exported, often in the hope of avoiding tariffs or quotas imposed by the trading partners. For example, let's say I'm an oil company and we decide that we will not export enough oil. Why? So that your country stops import duties on it and makes my good relatively easily sellable in your country. So this is like, backfiring because you have put some restrictions on the goods or put some tariffs or quotas. Therefore, I don't want to sell it. It's like, I'm angry. I don't want to come to the office today. That's called voluntary export restrict. Okay. So you don't want to do it because you are angry or something like that. You don't want to sell your goods to avoid those quotas and tariffs. That's called voluntary export restraint. Is that clear? Any questions, anyone? Come on, tell me. Everyone cleared with trade restrictions?
Yes.
Yes.
Now I will show you a situation of what happens if there is a trade restriction, and let's say take that trade restriction as tariff. Tariff is, let's say, import duty. Okay. So here is a situation of demand and supply. Now I'll focus on one by one aspect, and I want your complete attention to what I do here. Let's say we live in a world where you have this price demand, or quantity demanded and quantity supplied. So you have domestic supply and domestic demand, and it meets at a particular price. So let's say at this price P, your domestic demand is here. At price P, how much will I demand at this point? Correct? This is going to be my quantity demanded if there is restriction or if there is no restriction, assuming that there is no restriction. It's
No
free
restriction.
trade. So this Q4 will be quantity demanded 1. Let me put that as 1 for your reference. If there is no restriction. And what will be the supply? The supply will be at this point, Q1. You see, I'm connecting the supply line. Clear? So this supply will be QS1. I'm putting QS1. QS1 is the supply and QD1 is the demand. Correct? Assume it's a car demand. Now, the demand for car is more than the supply for car. Clear? Right? So this situation will persist if there is restriction or if there is no restriction.
No restrictions.
No restriction. Then what will be your price? This will be your P. This P is called P world. This will be your world price, assuming that there is no restriction. So your price will be P world. Your quantity supplied will be Q1 and your quantity demanded will be QD1. That is Q4 here in this case. This will be the situation when there will be free trade. Are you with me on this?
Yes.
Correct. I'll just focus on this. Here will be the demand. Here will be the supply. Okay. Now, ideally, this should be the case. So the demand is definitely higher than the supply. So what should be the situation? There should be more supply, right? Correct. Now, what if the domestic country is not able to supply more? Then there should be imports, isn't it? Well, if there is an import, what will happen? The supply will be more, correct?
Yes.
But along with that, what happens that the government puts import duties. It doesn't let the import come at the same world price. It lets the import come at a higher price. So now the new price is P protection. What is P protection? P1. Why P1? This is due to tariff. Are you with me? Yes or no, everyone? So
Yes.
due to tariff, the prices have increased. Well, if the price increases, what happens to the demand? If the price increases, the demand will go down and the supply will increase. Are you getting it?
Yes.
Clear? So this new QS2, I will name this as QS2 and QD1. This situation that you see, this situation is due to free trade or due to restricted trade?
Restricted.
Restricted trade or due to protection. So what has happened due to protection? Can you tell me what all has happened? The demand has
Decreased.
decreased, the supply has increased, and the prices have
Increased.
increased. Now I want your focus. I know it's a bit messed up here. Overall, if the demand and the quantity, if the demand has decreased, the quantity supplied has increased, this gap that you see here, especially let me put this, I'll put in green, this line, this vertical line that you see here till this point, this is the vertical line that you see. This is who will make this money? Who will make this money? Customers or producers? This increase in price and quantity. Producer, right? So this section is called producer surplus, or it is called gain in producer's surplus. Correct? What happened to the price? The price was increased slightly. So right in the middle, that this increase in price and quantity is due to tariffs, right? Who makes this money? Who makes this money? This tariff money or this tariff revenue. Who makes this money?
Government.
Government. So it is also called as the government surplus. Clear? Right? And overall, if you notice, there is in between, if you notice, there is this gap. This gap. Now, this gap is what? That's what we will be discussing. This gap that you see here is called dead weight loss. Dead weight loss. What is it called as? Dead weight loss. I will discuss what exactly it is. Basically, this dead weight loss, I'll keep it blank. Dead weight loss is a blank portion. No one makes this money. It is neither for the benefit of the consumer, nor for the government, nor for the producer. We lose things here. Why? Because the quantity supplied has become more, but the demand has become less. So there's this blank triangles that you see here. These triangles that you see, they are called dead weight loss. I'll explain you each and everything. Don't worry. So let's focus on one by one. What is P world, QS1 and QD1? That was a situation before P world, QS1 and QD1 when there was restriction or no restriction?
No restriction.
No restriction. It was the price, demand and supply. But P protection, QS2 and QD2 are the new domestic price, quantity supplied and demanded due to restrictions. Clear? So this is due to restriction and that is due to no restrictions. Now, if I include a tariff and an equivalent quota, so let's assume that there is a tariff or quota, both will do what? They will increase the price. What will happen? Due to tariff or quota, prices have increased. Am I correct? From P world, it has gone to P protection. Yes or no?
Yes.
Right? So it has gone from P world to P protection. Now, what are its effect? At P world, what was the situation at P world? See this. At P world, what was the situation at P world? Quantity supplied was as QS1, demand was at QD1. Therefore, with difference equal to the quantity imported, what was the difference? Difference between QD1 and QS1.
QS.
Correct? Now, when I place a tariff, what has happened? The import increases the domestic price, increases the quantity supplied and decreases the quantity demanded. That's what we observe. So what exactly happens due to this? Let's discuss that. So I'll just erase this. Give me. Yeah. So what is consumer surplus? The entire shaded area represents a loss of consumer surplus. I will now highlight. See this. This is what consumers lose. Why they lose? This entire area. Why they lose? Because the prices have increased and that has resulted in lower demand. Are you getting it? And more supply. So this is the, because of high import duty, is everyone buying imported car? No. For someone like me, I'm a fan of some imported cars, but I'm not able to buy because of the duty. So I will never buy that imported car. Are you getting it? That's the consumer loss that we are facing due to the tariffs. Is that clear? Yes or no? That's a consumer loss. Everyone with me? Yes or no?
Yes.
On the other end, producers benefit. The portion of vertical lines, see this one, the first one here. That area left to the domestic supply curve between P protection and P world represents the gain the producers suppliers of the suppliers of domestic products. So basically your local those who are supplying in your local market, whether it's domestic or foreign players, they will be able to sell at a higher price and more quantity. That's called producer surplus. Clear? Government also benefits. Why? With that horizontal lines that we saw, they are going to benefit due to tariff. Correct? That's right in the center. The one with the horizontal lines. Clear? That's your government benefits. Am I clear? And in between those blank spaces that you see, the more remaining triangle areas are the deadweight loss from the restriction on free trade. Well, that's something that no one benefits. So first of all, what is the overall loss? The shaded area. But out of that loss, the producers benefit, the government benefits, and some portion no one benefits. That's called the deadweight loss. No one benefits. So what do you notice overall? Due to trade restrictions like tariffs, demand has become less, prices have become more, overall consumers lose. There is some gain to the producers and government, but overall there is a loss of consumer surplus. Is that clear?
Yes.
And that loss is visible in the deadweight losses. That's the drawback of putting trade restrictions on import and export. Am I clear? Any questions? Any doubts? Now, similar to trade restrictions, governments also put capital restrictions. Capital means restrictions on borrowing and lending. Okay. So capital restrictions are restrictions with the flow of financial capital across borders. What can be the reasons, or what can be the ways? First, we'll understand the ways and then the reasons about it. Outright prohibition of investment in domestic country by foreigners. So no foreign investment is allowed in the country. This is done by countries like India, where we are still not out of the trauma of East India Company, which came into India as investors and took over our country, right? So
Yes.
outright prohibition in many, we still do have outright prohibition in various products. That's completely, but products in trade, not in capital. I think now in India, we are at a stage that we have no restriction on foreign investments, except in few spaces. Prohibition of or taxes on income earned by foreign investments. So yes, this is one restriction that we have, where the foreign investors are taxed differently in India. Okay. Prohibition on foreign investment in certain domestic industries. So we don't allow foreign investment in various sections, like insurance, we have now opened it, but defense and healthcare and many sectors where we do not freely allow movement of capital. And yes, there is one more thing, restriction on repatriation of earnings by foreign entities. This is one of the worst things, that all those foreigners who invested in your country, now when they want to withdraw, you stop their withdrawal. That is, you don't let them repatriate the money. This is one of the worst form of capital restrictions. Mostly countries don't go to such an extent, otherwise no one will invest in their countries. But the other top three approaches, many countries do follow that. What happens due to capital restrictions? Well, it decreases economic welfare. In the short run, they have helped developing countries to avoid the volatility due to the capital inflow and outflow. But they do not offset the long-term cost if the country does not get foreign capital. Like see the situation of North Korea and Iran, when they don't have a lot of foreign capital, their country's economy is completely devastated. You cannot restrict foreign capital. That's one of the you cannot stop this foreign investment, because every country does require foreign investment in today's world. Clear? So definitely having capital restriction is one of the worst things. Therefore, many countries do have trade restrictions in few products, but hardly these days countries have capital restrictions. Okay. Now, there are some countries which do have capital restrictions, and what are the reasons that they give? The reasons that they give are to reduce volatility of asset prices and currencies. They don't want the currencies or asset prices to be too much volatile. They want to keep the domestic interest low, because if the capital comes in and out, there will be volatility in the interest rate also. Correct? And they want to protect some industries. So there are some industries like defense or insurance where they don't want foreign capital to dominate. Now, for trade restrictions, governments apply strategies like tariff, quotas. Correct? What else? Do you recollect? What do they do for trade restrictions? Subsidies, export subsidies, minimum domestic content, voluntary export restraint, right? For capital restrictions, what governments do, they create trading blocks. Trading blocks means trading unions. They are called trading blocks, common markets, or economic unions, right? There are various types of agreements amongst countries with respect to trade policies. What is the purpose of this? That within those agreement, within those pact, all those countries within those pact reduce trade barriers amongst the countries by eliminating or removing trade or capital restrictions. So what are trading blocks? Trading blocks are generally meant to remove the trade or capital restrictions between the member companies or member countries. Now I'll explain you few of them. So you just need to know, and I've given some examples of it in detail. You don't have to read all this thing, okay? This is just for your reference, this extra information. Now, what are the trading blocks or trading unions? Why are trading blocks or unions created? To tell me. We just discussed why are trading blocks or unions created? Why are trading blocks or unions created? Well, they are created for one important reason, that there is no restriction within the member states for movement of trade or capital. Not only trade or capital, but in many cases, not even in the movement of people. So, free trade areas. The first type of trading block is free trade area. Now, I have mentioned here what basically are trading blocks, and all the trading blocks, they have different names, but the difference is only about some restrictions which are there and some restrictions which are open. So if you see free trade areas, which is like NAFTA or RCEP, NAFTA is the trade union between the North American countries of US, Canada, and Mexico. Now, that's only free trade, means no barriers to trade. That's it. But if you take one more step, you have custom unions where there is no barriers to trade, but also restriction with non-members, like GCC. GCC is a custom union. What it does? It trades within the members, but it also restricts few places where they come to a conclusion that they will not trade. So OPEC in the 70s and 80s decided not to sell crude oil or not to produce crude enough and let many countries suffer. So those are custom unions. So custom unions have no trade barriers between them, but they also apply restriction on other members. Then there is common market, which has one more additional feature, is no barrier to the movement of labor and capital. So the labor from one country can move to another country easily without a lot of hassle. That is an example of ASEAN. ASEAN is a Southeast Asian collaboration of countries like Thailand, Indonesia, Malaysia, and all, right? So they hardly have restriction on the movement of labor. Now, if I go a step further, there are economic unions where they establish common institutions, and the classic example of that is European Union. European Union has 27 members in it, and they have common institutions, like they have a common central bank, ECB, European Central Bank. Clear? They also have common forces like NATO. Okay, so they also have common military, by the way. And finally, there is one form of trading bloc which also adopts a single currency, and that is only very few of those we have, and one of that is Eurozone. What is Eurozone? Eurozone is, see, in European Union there are 27 nations, but not all of them have euro. But in Eurozone there are 19 members which have adopted euro as their currencies, including Greece, Germany, France, Italy, Spain. They have also adopted their currency as euro. Clear? Now, do you know an interesting part? That the one who was proposing this European Union was UK. Okay, so UK was a part of economic union, but its currency did not change. Its currency was pound. Correct? So UK was a part of economic union, but not monetary union. Am I clear? Yes or no?
Yes.
Monetary union is Germany and France, who have changed their currency also to a common currency of euro. Clear? These are trading blocks or common markets created to boost the trade and capital flow easily within the countries. Clear? Everyone? This is just for your reference. I have also put RCEP, which is one of the largest free trade agreement between China and various other nations, including Australia and New Zealand, and many countries have joined in RCEP. This is a counter to what US was planning to do with NAFTA, or US has done with NAFTA. So this is said to be the Silk Route that, or the Asia, so not the Silk Route. This is the Asian trading bloc, you can say, overall. Asian and the other countries trading bloc. Okay, one of the very strong free trade agreement, RCEP. Clear? Everyone? I've made this all in the table, so it becomes very easy for you all to understand the difference between all. So we discussed about the trade restrictions and capital restrictions, right? Now we move to an important part, that is how the accounting of foreign trade is done, or foreign inflow and outflow of capital and trade is done in the country's financial system. So tell me, for your company's financial system, you do have income statement and balance sheet made, right? Correct? In the same way, a country's financial system, especially with regards to foreign currency, does have, you can say, income statement and balance sheet. So it's also a double entry bookkeeping system of a country's economic transactions with the rest of the world for a particular period, let's say 1 year. So what is this? This is nothing but the bookkeeping system, which has all the debit and the credit entries. And what should happen? The difference between debit and credit should eventually become zero, because they both should match, right?
Yes.
This accounting of countries' foreign inflows and outflows is called balance of payments. Now there are debits which are increase in assets. Asset means goods. When you import goods, your inventory increases. When you purchase foreign assets, your asset value increases. When you get money, when you receive money from foreigners, your cash or your asset increases, correct? But it also has decrease in liabilities, means increase in debt owed by foreigners. So that's again loans and foreigners, debt owed by foreigners. Okay, owed by foreigners means there is a difference. Owed to foreigners means you have to pay them, so that's an increase in liability. But owed from foreigners means increase in assets. Or if you pay some liabilities, that's called going to be decrease in liabilities. Clear? All these are debit entries. Credit entries are those which are decrease in assets. That's exactly opposite. Instead of import, when you sell goods, export, when you pay for foreign assets, when you pay for imports of goods and services, all these are going to reduce your assets or increase your liability. Clear? All this are credit items. Now you don't have to memorize the credit and debit items, but you need to know that what comes in, or anything that increases in your assets value or reduces your liability is something that is debited in your account, and something that will be credited from your account is whatever goes out. So decreases in assets or increase in liabilities. Now you don't have to memorize this, but you have to understand that overall balance of payment consists of three things: current account, capital account, and financial account. Now most of the times, the capital and financial account by most of the economies is considered as same, which means they are clubbed together. They are clubbed together. They are clubbed together. They are not kept separate. Okay. So what is current account, capital account, and financial account? For me as an individual, I have always understood current account as income statement and capital account as balance sheet. Okay, so for me, current account, and I'm sure for you also, you will easily connect. Current account is income statement, assume that, profit and loss account. And capital account is balance sheet. Capital is in the balance sheet, right? This is my technique of understanding, and even you will probably find it easier. So in the day-to-day activities, you report, for example, what happens in a particular year, you report that in income statement or in balance sheet?
Income statement.
Income statement. So all the exports and imports, basically all activities related to trade is in the income statement, that is in the current account. So what all are there in current accounts? Merchandise, that is all the export and import of goods, correct? Or manufactured products. Services, exports and imports of services like tourism, transportation, IT, movies, whatever you name, all those services are part of current account. So export and import of goods and services are part of current account, because what happens, they are all having one-time effect. Why do I say one-time effect? When you sell goods to a particular country, you sell them and you get your money paid, that's it. Is there going to be anything reverse about this? No. In the same way, income receipts, these are money that you receive from your investment abroad, or you pay for someone investing in your country. For example, what is the money that you receive, or income that you receive on your investment? Dividends and interest, right? So dividend and interest that you receive or pay because of your foreign investment or because of foreigners investing in your country, all that is part of income receipts. Clear? Unilateral transfers, yes, these are what many Indian workers or many Southeast Asian workers do work in the Middle East and as laborers, or many of them work in US and Europe as IT experts. And whatever money that they transfer back home, those remittances from abroad are part of unilateral transfer. They are one-way transfer. Okay. Even governments transfer some money as a one-time benefit to the country in the form of some aid or benefit, especially during the times of flood or some natural crisis. All these are current account. Why current account? Because they have a one-way effect. Is that clear?
Yes.
But a capital account has two-way effect. But before that, let me describe what is a capital and financial account. As I said, both are considered generally same. They both are clubbed together. So capital account means capital transfers. Capital transfer means debt forgiveness and migrant transfer, transfer of title to fixed asset, transfer of funds from one country to another country for buying assets, right? Gifts and inherent taxes, debt duties and uninsured damages to fixed assets and legacies. All these are transfer of some capital assets from one country to another country. In the same way, sales and purchases of non-produced, non-financial assets. Non-financial assets, for example, if I buy an oil field from Qatar or from UAE, that's purchasing of non-financial asset. That's called a capital account. Clear? Everyone? Financial account, on the other end, is purchasing and selling of financial assets, which is debt and equity, isn't it? So financial account deals with majorly securities. Are you with me? These securities can be gold, foreign currencies, reserve position in IMF, FDI, claim against foreign banks. Most of these financial accounts are related to government owned assets abroad. So when government has investments abroad, that's called financial account. On the simultaneous side, those foreign companies will have investments in your country. So foreign owned assets in your country, they are divided into foreign official assets, like, when foreign embassies have properties in India, that's a part of, they have assets in India, right? So that's a financial account. Other foreign assets in the domestic country, these assets include domestic government and corporate securities like bonds. So let's say a foreign company has purchased Indian government bonds, that will be a part of financial account. Clear? Everyone? Yes or no?
Yes.
Or if the government of India has purchased US treasury bonds, that will be a part of financial accounts, but government owned. Whereas if we purchase physical assets, then that becomes a part of capital account. Correct? So overall, when you buy securities or assets, fixed assets or securities, they are part of which account? They are part of
Capital.
capital or financial account. Clear? But when you buy or sell goods, then that's part of current account. I told your current account is one way, but capital account is two way. Why two way? Because let's say that a foreign company has invested in Indian government bonds today. So there is an inflow in the country. Correct. But later on, when they will when there will be maturity, there will be also an outflow, right? So capital account or financial account has
Two ways.
two ways, two effects. They right now come, so it's an inflow. When they go back, it's an outflow. Now, what should happen to income statement and balance sheet? Well, eventually they should tally. So tell me one thing logically. Now think of it that you are the head of the country. If your exports are less than your imports, means you buy $100 goods, but you only sell $80 goods. So how are you going to pay that $20 difference? Borrowings, right? So when you bring in financial capital from abroad, that's called capital account surplus. But when your imports are more than your exports, it's called current account deficit. So the deficit in current account is met by surplus in the capital and financial account. Is that clear? On the other end, just imagine if your exports are more, which means you are like China, you are selling $100 goods and you only bought $40 goods. So you have $60 more. What will you do? You will start investing it abroad. That's an outflow in capital account. Clear? So tell me, repeat after me. A trade surplus will result in what? A trade surplus will result in what? All this is going to come in your exams. If there is a trade surplus, what will you do? Keep the logic. Will you keep that money with you or will you buy something?
Buy.
Of course, you'll buy something.
So invest.
UAE and Qatar, when they sell so much of crude, what do they do with that dollars? They buy foreign luxury goods. Okay, they invest abroad. So, coming to the point, whenever there is a current account deficit, it should be funded by a capital account surplus. On the other end, when there is a current account surplus, means your exports are more, there will be a capital account deficit, means more money will be invested abroad than the money coming in. So, deficit in one account should be met by a surplus in another account. Therefore, it's called balance of payment because it will always balance. Clear? So, for a country with trade deficit, it must be balanced by a surplus in
Another
capital and financial
capital.
accounts. As I said, investment analysts do what? They think of all financing flows as single capital account, which combines capital and financial account. So analysts consider capital account as one, which includes physical and financial capital. Clear? So for me, capital account is balance sheet. Thinking in this way, any deficit in the current account must be made up by a surplus in the combined account. So excess of imports is nothing but deficit in current account, should be balanced by borrowings, sale of assets and debts to the foreign countries. On the other end, if there is a current account surplus, it should be offset by purchase of foreign or physical assets. So there will be an outflow. So conclusion, current account deficit should be balanced by a capital account surplus, or a current account surplus should be balanced by a capital account deficit, and therefore it's called, therefore what do I say? Balance of payment should always balance. So now if you look at China, which has a current account,
Surplus.
yes, it has a current account surplus. Therefore Chinese have more money, and therefore they buy assets in Australia, New Zealand, Europe, everywhere. Therefore China is investing abroad. It is able to invest its capital. So there's a capital outflow from China, right, because of its trade surplus. Contrary to that, a country like India, which has a trade deficit, therefore we always keep on borrowing from abroad. Clear? So we have a capital account surplus. Can it happen that a country has capital account and current account surplus both? Which means there is a lot of FDI investment in your country and your exports are also high. That's what happened with China. There was huge foreign investment in the 90s and 2000s, and China also had a current account surplus. Well, that means you have money flowing from all the points. That's where you increase. What happens? When you have too much of profits, what happens? From the financial statement perspective, what happens to the profit? Where does the profit go? Where does the
Invest.
income go? In your financial accounts, profits, retained earnings. Retained earning increases what? It increases your shareholders fund or your
Shareholders.
reserve. Correct. That retained earning is also called reserves. Are you with me? It's also called as reserves and surplus. So when China is in fact having capital account and current account both surplus, its reserves increases. Have we discussed something about that? Yes, no?
Yes.
What do you where was it? Where
It was
is
just
reserves? Do you know how much reserves China has built? Why? Because it had a current account and capital account surplus. Clear? That's where Chinese reserves have increased so much. Got my point? We discussed that in the last section. Clear till this point, everyone? Now, we need to understand this from the economic angle of the GDP equation. Well, we knew the GDP equation, and let me show you that GDP equation. You remember this equation? Total of expenditure should be total of income. C plus I plus G plus X minus M should be C plus S plus T. That is consumption and savings and taxes. Now, if you recollect that from the aggregate demand and output, basically, when we cancelled out C, what did we get? Savings equals to investment plus G minus T is government borrowings minus government savings. Basically, G minus T is how much government spends and how much government earns. That is fiscal deficit or fiscal balance. And X minus M is trade balance.
trade balance.
So if I take I on the other side, it is S minus I, which is savings minus investment. Correct? So G minus T is equal to S minus I minus X minus M. You recollect this? So what is important is to understand this equation based on aggregate income equals to planned expenditure. You see this? So my equation is savings minus investment. Savings minus investment equals to fiscal balance plus trade balance. Correct? Now see this.
Yes.
What have I concluded? This savings minus investment is equal to fiscal balance and trade balance. Now fiscal balance is nothing but G minus T and trade balance is nothing but X minus M. So if I rearrange the equation, I get this. Now, what is the most important? We are discussing about international trade. So what is trade? Trade is nothing but X minus M. So if I keep X minus M on one end and I keep everything on the other end, what do I have on the other end? I have on the other end G minus T and S minus I. Is that clear? So basically, I have savings and investment from the government side and from the individual side. Is that clear? S minus I is private savings and investment, while G minus T is government savings and investment, which is due to government spending and government revenue. Correct? Now, what is that we conclude here? Very important thing that I want to focus. Now, tell me, in a country, if the savings are less than the investment, if the savings are less than investment, talk to me naturally, where will you get the money from? If people save less in the country and there is more requirement of investment.
Borrow.
Yes. In this case, we will have to resort to borrowings. When I say borrowings, that means it is a capital account surplus, isn't it?
Yes.
Borrowing means capital account surplus. Now, how do I prove that this with the equation here? See here, the equation that you have is S minus I equals to, I will rearrange that equation. So how do I write? S minus I equals to G minus T plus X minus M, correct? So now see, just notice if this left hand side S minus I is less, which means the left hand side value has become less. Why? Investment requirement is more and the savings are less. Clear? So tell me, if this part is going down, even this part should go down? Yes or no?
Yes.
When the right hand side part goes down, just focus on X minus M. What is X minus M?
Export minus import.
So if export minus import is going down, what does it mean? That there is a current account deficit or a current account surplus?
Current account deficit.
Current account deficit. Now, all that I have written is just to prove a point. What is that point? See this. If a country's net savings, both private and government, are less than amount of investment, then the investment must be financed by foreign borrowing. So you'll require a capital account surplus. And when you have a foreign borrowing, which results in capital account surplus, it means that there is a trade deficit. So the conclusion, which proves from the equation of aggregate demand and output, which we discussed, that if there is more investment required in your country, then you will have to depend on capital account surplus, which, to make the balance of payment equation balance, will result in current account deficit. So just imagine, if you have to import more goods, you will require more money, but your saving isn't sufficient. Then what will you have to do? You'll have to depend on foreign borrowing. Clear?
Yes.
That's what this equation tells us. Okay. Now we will discuss about this equation in the next topic and its effect on the currency as well. But now the last thing about this topic is international organizations, which are very active in the global supporting of global trade and capital flows. Now, of course, they are set up with various objectives. So let me tell you, after the collapse of Germany in the Second World War, when Hitler was just about to die in 1944, Hitler, by the way, the World War finished in 1945 with the last of Hiroshima and Nagasaki in Japan. But in 1944, these allied nations, which were against Germany and Japan, they came up in a place in US called Bretton Woods. And there they came up with an agreement to stop the war and now start working towards uplifting the economies. So that's where they came up with one of the world's most prominent global organizations to facilitate trade, capital, and uplift the poverty which was there after the World War. Okay, so they decided that now the world war is getting finished. It's better we come together and form a global union to avoid this trade and capital related issues. So three major organizations come to exist after the Bretton Woods of 1944. Bretton Woods is a place in US where the agreement was signed. So those three organizations are IMF, International Monetary Fund. It deals everything about money. So it promotes monetary cooperation, basically amongst the banks. So global banks or finance secretaries, they follow instructions from IMF. It facilitates expansion and balanced growth of international trade, exchange stability, system for payments, basically the banking system, making resources available to members experiencing balance of payment difficulties. So if country like India or Bangladesh face or Pakistan faces some financial difficulties, then IMF supports by lending some money. So IMF, you can say, is a bank of all the banks. It's a bank of the central bank, or sorry, you can say it's a central bank of all the central banks. So IMF decides or takes a decision of what happens to every country's financial system and how they should be managed, and it also supports in terms of those management. So that is, IMF is, you can say, the central bank of the world. Clear? The second organization which was set up is World Bank Group. World Bank was also known as IBRD, International Bank for Reconstruction and Development. It was majorly set up after the World War because of the infrastructure destruction that had happened in Germany, Japan, and various countries. However, over the period, its focus was to help developing countries fight poverty. Therefore, World Bank has a lot of projects in India for slum rehabilitation. Clear? So it wants to fight poverty, enhance environmentally sound economic growth. So what is their objective? Their objective is to grow and attract businesses, for which they want to strengthen their government and educate the government officials. So they promote more of, they work more for not making money, but more for helping the poor nations or developing nations. Are you with me on this? They implement legal and judicial system that encourages business, protect individual and property rights to honor the contracts, because these are very weak in the emerging nations. Yes or no? Develop financial system that robust enough to support endeavors ranging from microcredit financing large corporate ventures to financing large corporate ventures. So they also focus heavily on microfinance, due to which the head of Grameen Bank of Bangladesh, Mohammed Yusuf, received Nobel Prize in economics for. So they basically support microfinance a lot, right? And their major task is to reduce poverty and reduce corruption. That's their major task of World Bank. So World Bank has a more supportive role for emerging or poor economies. Now, if there is any trade disagreement between, let's say, China and US or India and China, then where should they go? Well, they can go to WTO. WTO provides a legal and institutional foundation for multinational or for various countries. Why? Because every country have their own laws. So it is the only international organization that regulates cross-border trade relationships. So as I said, if there is any conflict between India and China, or India and USA, or US and China, or US and Europe, they should go to the common place for them to settle their dispute is WTO. WTO's most important function are administration and operation of individual agreements, platform for negotiation and settling dispute. Settling dispute is one of the biggest objective of WTO. Yes or no? Have you heard about that? Yes, WTO is always against those who do unfair trade practices. It has made mandate to review and propagate its members' trade policy and ensure coherence and transparency of trade policies. So do you know which country has one of the largest complaints in WTO? India and China have one of the largest complaints in WTO. Okay. But simultaneously, India and China has also complained a lot about the Western countries. So there's constant argument. It is only in WTO where India and China stand together against the Western countries. Okay. Provide technical cooperation and trading to developed countries, so that everyone complies with the rules. It's a major source of economic research and analysis. Yes. So whenever I want to know what's happening in the global trade, whether it's increasing or decreasing, WTO maintains that data, and it's a good resource for all the economists and investment analysts in the world. Okay. Is in close cooperation with the other two Bretton Woods institution of IMF and World Bank. So WTO works in accordance with IMF and World Bank. Clear? They are called the Bretton Woods institution because they were formed after the 1944, the Second World War, with the Bretton Woods Agreement. Everyone clear with the objective? So International Monetary Fund, monetary policy. IMF deals with monetary policy. World Bank deals with poverty and corruption. And WTO works for settlement of disputes between member nations. Clear? It settles trade disputes. Well, that's the end of international trade and capital flows. A very interesting topic. You should read it because that definitely, this topic is very, very important from understanding how economies function or economies work with respect to international trade, and what are the restrictions, are those restrictions valid or not. So how should a free economy should operate? That's what this particular topic tells us. Clear, everyone? Any questions? Anything? Okay. So if there are any questions, let me know, or else we'll move to the next topic. Any questions or anything? Anything? Okay. So we'll now move to the next topic. That is what we have is currency exchange. My favorite topic. This is currency exchange rate. In economics, this is my favorite because it also has a lot of calculation.